Hello there, good people. All you defiled, subjugated, and repressed troglodyte proletariat bipeds of this massive fuckery we call a planet. Economics, I want to talk about today. Economics is boring, complicated, and shit, which is why most people don't pay any attention to it. And even the people who do profess to understand it are taught that the way it works is quite good, even though it's absolutely fucking terribly appalling rubbish crap, and basically enslaves everybody in a situation where they never really have any money or wealth domestically. Like the US national debt is about 37 trillion quid and just never going to pay it off. And they spend loads of money on weapons and shit. So yeah, that's sound. I'm going to read you some stuff about economics now. It might sound a little bit boring and annoying, but the great thing is you get to be pissed off, right? So you go from being ignorant to suddenly righteously indignated and really, really pissed off at all the governments and people after the Second World War who made a system of economics and finance which, just like our water system and our gas system and our railways, were like all nationalised before Margaret Thatcher. There's basically the power to create money, which sounds quite fucked up, but the Bank of England, you're probably familiar with, they used to be able to create money, and they could regulate taxes and inflation by monitoring how many quids there were in circulation. You know, £50 notes and pennies and tums, halfpennies as it was in those days, before eventually they became a secondary kind of ancillary part of the ecosystem of financial design in the UK. And it's probably quite a long paper. It took bloody ages for a Gemini to work it out. So I'm hoping that when I read you this, you'll find it extra interesting. I'm just going to open it up now. And it loves the word architecture. It's always something is a fucking architecture whenever I look on Gemini. The architecture of global finance, deconstructing fiat currency, the £250 trillion debt matrix, and the imperative for sovereign money reform. Introduction. The hidden engine of the global economy. So the global economy operates upon a foundational architecture that remains largely invisible to the general public, widely misunderstood by the media and frequently obscured by policymakers. This architecture is the monetary system itself, the precise legal and digital mechanisms by which money is created, distributed, and eventually destroyed. For the majority of modern economic history, public discourse and political debates have focused almost exclusively on how money is taxed, spent, and redistributed, but the actual genesis of the currency has been treated as an esoteric, mechanical detail best left to central bankers and technical specialists. However, an exhaustive analysis of the international financial framework reveals that the current paradigm of fiat currency and fractional reserve banking is not merely a neutral medium of exchange. Instead, what it is an active structural force that shapes geopolitical power, dictates ecological outcomes, and drives socio-economic inequality on a planetary scale. So since the collapse of the Bretton Woods Agreement in the early 1970s, the world's operated on a system of fiat currencies entirely decoupled from physical commodities. In this modern paradigm, money is brought into existence almost exclusively through the issuance of debt by private commercial banks. This privatization of money creation has resulted in a global financial architecture defined by system fragility, exponential debt growth, and profound imbalances in power between the industrialized nations of the global north and the developing nations of the global south. The consequences of this system are far-reaching, extending well beyond the confines of central bank boardrooms and financial trading floors. The structural design of the international monetary system dictates the success or failure of almost every major progressive and humanitarian cause of the 21st century. So whether the objective might be mitigating anthropogenic climate change, that might be what you're into, or eradicating global poverty, or any good causes really, securing fundamental human rights, the prevailing debt-based monetary system acts as a systemic headwind. Developing nations are trapped in cycles of debt servitude, forced to liquidate their natural environments and dismantle public services to satisfy the relentless demand of international creditors and multinational institutions like the International Monetary Fund. Simultaneously, advanced economies suffer from staggering asset bubbles, industrial hollowing, and recurring financial crises engineered by unchecked, privatised credit expansion. It's lovely and noisy on the water there, isn't it? This comprehensive research report provides a deeply detailed examination of the global campaign movements currently mobilising against twin pillars of fiat currency and fractional reserve banking. It seems to demystify the inherently toxic nature of IMF structural adjustment loans, detailing in plain language exactly how these financial instruments extract wealth from the most vulnerable populations on Earth. Furthermore, it explores the historical and contemporary role of the Bank for International Settlements, the so-called Bank for Central Banks, in overseeing a post-Bretton Woods era that's generated an incomprehensible £250 trillion in digital debt-based money. By evaluating pragmatic, structural solutions as sovereign money systems, and by highlighting the critical insights presented in the groundbreaking documentary 97% Owned. There's loads of money reform documentaries. That's probably one of the best ones I've ever seen, so I would watch that. This analysis demonstrates that establishing a functional domestic economy free of debt-based currency is an absolute prerequisite for global stability. Ultimately, the evidence indicates that fundamental monetary reform is not like a fringe economic conspiracy theory. It's by far the most pressing, urgent and pragmatic social and political issue affecting nearly every country on the earth today. The mechanics of modern money, deconstructing fiat currency and fractional reserve banking. It has nothing to do with poor quality cars and everything to do with why you buy one house and pay for 5 over 30 years now when you get a mortgage. To comprehend the global movements advocating for radical monetary reform, it's first necessary to completely deconstruct the mechanics of the current financial system. The prevailing public assumption, and indeed a misconception perpetuated by many outdated economic textbooks and university curricula, is that commercial banks act merely as passive financial intermediaries. Under this traditional intuitive loanable funds model, it's assumed that banks take deposits from hard-working savers, hold those funds in a vault, and then lend those exact same funds out to borrowers. If this model were accurate, banks would simply be conduits moving pre-existing money through the economy, and the total supply of money would remain relatively stable. However, empirical reality, along with the explicit admissions of major central banks, contradicts this intermediation model entirely. In the modern fiat monetary system, commercial banks do not lend out pre-existing reserves. Instead, they create new money out of nothing every single time they issue a loan. So when a commercial bank approves a mortgage for a family or a massive line of credit for a corporation, it doesn't physically transfer funds from like a vault, or it doesn't deduct funds from another savings account. It simply makes a digital ledger entry. By typing numbers into the borrower's account, the bank literally creates new purchasing power. At that exact moment, new money is introduced into the broad money supply. It might sound like absolute bollocks, but it's the truth. The illusion of fractional reserves. So this system of money creation is historically rooted in what's called fractional reserve banking. The practice originated centuries ago with medieval goldsmiths who had acted as the first custodians of wealth. Members of the public would deposit their physical gold with a goldsmith for safekeeping, receiving a paper receipt in return. Over time, these paper receipts began to circulate in the local economy as a medium of exchange. I have to phone him back in a bit. They were much lighter and more convenient to carry than heavy gold coins. The goldsmiths soon realised a profound mathematical truth. Their customers rarely came to withdraw all their physical gold at the exact same time. Recognising this, the goldsmiths began to issue extra paper receipts, lending them out at interest for more gold than they actually had in their vaults. They held only a fraction of the gold in reserve. In the modern digital era, the concept of a fraction has been stretched to its absolute precarious limits. Regulatory capital and reserve requirements dictate that banks must hold only a tiny fraction of their massive liabilities, that's your accounts in the banks, in actual central bank reserves. So because money is now entirely digital, 97% of it is, hence the name of that documentary, the constraints of physical gold mining are gone. This allows commercial banks to expand their balance sheets exponentially, creating staggering amounts of credit based on sophisticated risk models and the assumption that the central bank will intervene if a systemic failure occurs. The most critical and devastating flaw in this system lies in the mathematics of debt. When a bank creates the principal amount of a loan, it introduces that specific sum of money into the economy. However, it does not create money required to pay the interest on the loan. So there's X amount of money in the economy, and then you create more of it. There's £1,000 in the economy. You lend somebody £100 at 10% interest. When they pay back the £100, there's only £990 left in the economy because they've had to pay back the principal and the interest. And if you keep doing that over and over again, you just run out of money and you become completely skint and in debt. When a bank creates the principal amount of a loan, it introduces that specific sum of money into the economy, but yet doesn't create enough money required to pay the interest. Because every loan carries an interest burden, there is always, by mathematical definition, more debt in the economic system than there is money available to repay it, which is why everyone is fucked. This structural mathematical deficit necessitates a perpetual exponential expansion of credit. New loans must constantly be issued, creating new money just to provide the economy with enough currency to serve the interest on the old loans. The economy is therefore held hostage to a growth imperative, must continually expand, consuming more natural resources, producing more goods and accumulating more debt simply to prevent the monetary architecture from collapsing in on itself. If the rate of new borrowing slows down, perhaps because consumers are already drowning in debt and can't take on more, or because banks become risk averse, the total money supply actually shrinks. As loans are repaid, the principal is extinguished, disappearing from the economy. Without a constant influx of new loans, liquidity dries up, triggering waves of defaults, mass foreclosures and severe economic depressions. This is not a bug in the system, it's a core feature of fractional reserve banking. The economy is perpetually poised on the edge of a precipice, requiring ever greater injections of debt to stave off collapse. Currently, approximately 97% of the broad money supply in advanced economies such as the United Kingdom exists solely as digital bank deposits created through this private debt issuance. So physical cash like coins and banknotes, which are the only forms of money actually created by the sovereign state, accounts for a mere 3% of the money in circulation. This staggering imbalance means that the vital, indispensable public utility of providing a nation's medium of exchange has been almost completely outsourced to private profit-maximising corporations. The ascent of global campaign movements against the status quo. So, in response to the inherent instability, opacity, and profound inequity of this system, a robust and highly coordinated global network of campaign movements has emerged over the past decade. These organisations represent a growing consensus among dissident economists, progressive policymakers, and informed citizens that The power to create money must be decoupled from the provision of private debt. Prominent among these movements is positive money in the United Kingdom, which has been instrumental in dragging the mechanics of money creation into the light of public scrutiny. Similar initiatives have gained massive traction globally, including sovereign money initiative in Switzerland, which successfully pushed the issue of money creation to a national referendum in 2018. In the States, organisations such as the American Monetary Institute, I think that was a guy called Steven Zarlenga, if I remember off the top of my head, I think it was something to do with it. I've spent decades advocating for the nationalisation of the money supply, drawing upon historical frameworks like the Chicago Plan of the 1930s. These global reform movements present as a unified, devastating critique of the current financial architecture, arguing that allowing private banks to control the money supply yields catastrophic socio-economic results across multiple vectors. So first of all, you've got the system that directs wealth towards speculation rather than production. Because commercial banks are profit-seeking entities, they inherently direct newly created money towards sectors that offer the highest and safest return in collateral. In practice, this means the vast majority of newly created money is pumped into existing property markets and financial speculation, rather than, for instance, being invested in productive, job-creating enterprises in the real economy. This dynamic is the primary driver of modern asset bubbles. It starts to get a bit complicated, but I'm trying to keep it simple with this prompt anyway, that spat this out after like an hour of thinking. By continually injecting new credit into the housing market, banks artificially inflate property values. That's why houses are so expensive, because of this shit. So rendering home ownership unaffordable for average citizens, while simultaneously enriching a small entrenched class of asset holders. The result is a widening chasm of wealth inequality directly engineered by the mechanics of credit creation. Second, the fractional reserve system is fiercely and dangerously pro-cyclical. What that means is that during periods of economic optimism, banks display high confidence and issue credit aggressively, which floods the economy with newly created money, fueling rapid, unsustainable booms and exacerbating inflation. Conversely, at the first sign of an economic downturn, banks restrict lending to protect their balance sheet. This shrinks the money supply precisely when the economy is starving for liquidity, turning a mild recession into a devastating depression. This violent boom and bust cycle is not a natural economic rhythm, it's a synthetic crisis generated by the private control of money. This dynamic culminated catastrophically in the 2008 global financial crisis, an event triggered directly by the unchecked, opaque creation of toxic credit by the private financial sector. Finally, global reform movements that argue that the privatisation of money creation operates as a massive hidden subsidy to the banking sector. Banks are granted the extraordinary, almost magical privilege of extracting interest from currency that they simply conjured into existence via a keyboard stroke. This allows the financial sector to siphon vast amounts of wealth from the productive economy. By advocating for the total abolition of fractional reserve banking and the transition to a system where the state reclaims its sovereign right to issue debt-free currency, these movements aim to permanently democratise the financial system, eliminate the growth imperative, and stabilise the global macroeconomy. This also might sound like jargonised bullshit, but I'm sure it will make sense to most of you. So there's this thing called the BIS, the Bank for International Settlements. It's more like 270 trillion, but that was what I put into the prompt, 250. I said over 250. And they're referring to it here as a debt matrix. Nothing to do with Keanu Reeves, red pills, blue pills, or superficially sort of generated holographic realities. Everything to do with an equally sparse and absurd complexity, which like is probably more fucking weird than the Matrix movie is, to be fair. To fully contextualise the explosive proliferation of debt-based fiat currency, one must look beyond the operations of individual commercial banks and examine the institutional oversight of the global financial architecture. Some more architecture there. At the absolute apex of this hierarchy sits the Bank for International Settlements, BIS, operating from a heavily guarded tower in Basel, Switzerland. The Bank for International Settlements is the world's oldest international financial institution, yet it remains remarkably obscure to the general public. No one really knows what it is or who they are. They're very important and they're incredibly powerful. The origins of the BIS are deeply entangled in the geopolitical wreckage of the early 20th century. The institution was established in 1930 following the Hague Conference, operating under the framework of the Young Plan. Its initial highly specific mandate was to manage the collection, administration and distribution of the punitive reparation payments imposed on Germany by the Treaty of Versailles following the First World War. However, the reparations became quite quickly collapsed assets under the weight of the Great Depression, which happened around that time, leaving newly formed BIS without its primary purpose. Rather than dissolving, the BIS pivoted, transformed its legal status, combining features of combining features of a private sector company with the sweeping immunities of a public international organisation to serve as a permanent forum for the world's central bankers. During the Second World War, the BIS maintained a highly controversial stance. They basically funded both sides of the Second World War, of neutrality, they called it. So it kept its doors open and facilitated transactions for belligerent nations, including the shipment of looted gold from occupied Europe, which deeply alarmed the Allied powers. This controversy came to a head in 1944 during the historic Bretton Woods Conference in New Hampshire. The delegates tasked with designing the post-war economic order explicitly passed a resolution recommending the immediate liquidation of the Bank of International Settlements. Influential figures, including the legendary British economist John Maynard Keynes, viewed the BIS as a dangerous relic that facilitated unacceptable capital movements and harboured deep conflicts of interest. The Bretton Woods architects preferred to place global financial governance entirely in the hands of their newly created institutions, the International Monetary Fund, IMF, you probably heard of them, and the International Bank for Reconstruction and Development, the World Bank, you probably heard of the World Bank too. Despite this formal resolution, the liquidation never occurred. The Bank of International Settlements leveraged its unique extraterritorial status and its deep connections with powerful central bank governors to survive the post-war transition. It entrenched itself as the ultimate central bank for central banks operating behind closed doors to shape global monetary policy away from the scrutiny of democratic parliaments, keeping that power to create money as something that's outsourced to the private sector. Fucked up. Really, really fucked up. So the post-Bretton Woods explosion of digital debt, the financial system established at Bretton Woods was predicated on a strict gold dollar standard. So international currencies were pegged to the US dollar, and the dollar itself was strictly convertible into physical gold at a fixed unyielding rate of $35 an ounce. This framework provided a tangible physical anchor to the global monetary system. Because the money supply was tethered to a finite commodity, there were inherent hard limits on the amount of fiat currency and credit that could be brought into existence. However, by the late 1960s, the system began to buckle. The United States was running massive domestic deficits, funding expensive social programs, and bearing the exorbitant costs of the Vietnam War. To finance these endeavours, the US effectively exported its inflation, flooding the global system with dollars. Foreign nations, particularly France, recognised the discrepancy between the volume of dollars in circulation and the US gold reserves and began aggressively demanding physical gold in exchange for their paper dollars, or digital dollars. Facing the total depletion of its gold reserves, President Richard Nixon made a unilateral world-altering decision in 1971. He suspended the dollar's convertibility into gold, effectively severing the final link between money and physical reality. The event, known as the Nixon shock, terminated the Bretton Woods Agreement and plunged the global economy into a terrifying new paradigm of free-floating, entirely unbacked fiat currency. That's what fiat currency is. It's money that just says it's worth something, but it's just nothing. It's just something you swap with each other to arrange the sort of transfer of goods and services without it being anything other than that, just a medium of exchange. So in this newly deregulated, boundless environment, the BIS played another pivotal, they're like pivotal in architecture, two words this gentleman loves, pivotal role in coordinating the responses of global central banks. As cross-border capital flows surged, the Bank of International Settlements established international banking regulation, most notably the Basel Accords, which set the capital requirement ratios for commercial banks. That's how much money they got to keep in their accounts when you make an account with them. Unfettered by the physical constraints of gold and operating under BIS frameworks that required only fractional reserves, the global commercial banking sector began to create credit at unprecedented exponential rates. The concurrent modernisation of electronic banking and telecommunications allowed this credit creation to become entirely digital, facilitating instantaneous, frictionless debt expansion in every country in the world. The sheer scale of this expansion is difficult for the human mind to actually grasp. Since the termination of the Bretton Woods Agreement, the global monetary system has overseen the creation of more than 250 trillion quid in digital debt-based money. This incomprehensible figure encapsulates the staggering combined sum of sovereign national debt, as well as corporate liabilities and, like just people, household borrowing that currently suffocates the global economy. The velocity and volume of this digital money are accelerating. By 2027, in a couple of years, a year or so, the value of cross-border payments alone is expected to exceed that $250 trillion mark. Here it starts with 250 trillion quid rather than dollars. Bit of an inconsistency there. Well, it's not. It's saying it's going to be more than 250 trillion in next year. But this debt matrix, take the red pill, represents a systematic hazard of unparalleled historical proportions. The global economy is now utterly saturated with fixed income liabilities whose yields and servicing costs are highly sensitive to the interest rate policies dictated by central banks. When central banks attempt to combat the inevitable inflation caused by this fiat expansion by raising interest rates, the servicing costs on the monumental debt burden skyrocket. So the dynamic pushes sovereign nations towards default, forces heavily leveraged corporations into bankruptcy, and crushes ordinary households under the weight of mortgage and credit card payments. The Bank of International Settlement, while ostensibly tasked with maintaining global financial stability, actually presides over an inherently structurally unstable architecture where the very medium of global exchange requires a continuous, infinite expansion of systemic debt. A bit like my bank account notifications that keep popping up. Awesome source. The toxicity of IMF structural adjustment loans. So while the advanced economies of the global north struggle with the internal contradictions of massive asset bubbles and private household debt, the developing nations of the global south face a far more brutal and coercive manifestation of the fiat debt system. So because the global financial architecture is dominated by a few major reserve currencies, predominantly the US dollar, developing nations must conduct international trade, purchase vital energy imports, and service their foreign debts using a currency which they cannot print themselves. When these developing nations experience severe balance of payment crises, often precipitated by sudden external shocks, plunging commodity prices, or the compounding crushing interest of foreign denominated debt, they find themselves effectively shut out of private international capital markets. facing total economic collapse and lacking the sovereign power to generate the necessary foreign exchange. They're forced to turn the lender of last resort, the International Monetary Fund, to come and save the day. The IMF itself was formed alongside the World Bank during 1944 Bretton Woods Conference. Its original stated purpose was benign, just to facilitate global trade, promote exchange rate stability, and provide short-term financial assistance if there were countries facing temporary liquidity issues. However, over the decades, the reality of the IMF lending practices has drawn fierce, sustained criticism from human rights organisations, development economists, and the very citizens subjected to its policies. The crux of this criticism lies in the fact that IMF loans are rarely, if ever, issued simply as lines of credit. They're bound by incredibly strict, ideologically driven conditionalities. These conditions are codified in what are formally known as structural adjustment programs, SAPs. Destructuring structural adjustment in plain language. So again, a bit complicated. One of the reasons you might have already stopped this video, most people would have done, because economics is really boring and shit, but actually very important. So the term structural adjustment is a masterclass in bureaucratic euphemism designed to sound like a necessary mechanical fine-tuning of an economic engine. However, to understand why these loans are universally classified by critics as being toxic, one must strip away the dense economic jargon and examine the mechanics in plain language. So imagine a working class family facing sudden unexpected bankruptcy due to a medical emergency, for example, right in the United States. Desperate, they turn to a powerful, wealthy lender. The lender agrees to provide a bailout to stop the family from losing their home, but attaches severe conditions to the cash. The lender dictates that the family must immediately sell their car to a private buyer, pull their children out of school to save on tuition, stop buying nutritious food, and take on a second grueling job where all the new wages go to paying the lender's exorbitant interest rates. That's kind of what they do at the IMF, with the greatest of respect to some of their non-predatory action. Most of these structural readjustment loans are really shit deals for everyone. Structural adjustment programs operate on this exact same predatory premise, but they're applied to sovereign independent nations, so to governments. When the IMF provides emergency dollars to a struggling country, it dictates sweeping non-negotiable changes to that country's domestic laws, social safety nets, and broader economic policies. The primary goal of these conditions is almost never to improve the living standards of the country's citizens or to build long-term domestic prosperity. The ultimate overriding objective is to ensure that the country generates enough foreign currency, usually US dollars, to pay back its international creditors with Western bondholders. So the standard IMF structure adjustment playbook demands a highly specific set of neoliberal reforms. Number one is savage austerity and budget cuts within the nations they lend money to. The borrowing government is forced to drastically slash public spending. In the real world, this translates directly into firing public doctors and teachers, halting the construction of critical infrastructure, and eliminating life-saving consumer subsidies on basic food staples like heating oil and electricity. The social safety net is deliberately dismantled to free up cash for debt servicing. Second bit is often forced privatisation of public assets. So these governments are required to sell off their valuable state-owned enterprises, such as municipal water utilities, power grids, railways, telecommunication networks, that kind of shit. These are almost always sold at fire sale prices to private, often foreign multinational corporations. This leads to immediately increased utility costs for desperate citizens and represents a permanent transfer of public wealth into private hands. Then you've also got what happens is deregulation and trade liberalisation. Stick with me, this is boring you, but it really is important for you to get this through your head if this seems alien to you. The country must remove protective tariffs and quotas that shield local developing industries from aggressive foreign competition. Simultaneously, countries forced to alter its labour laws, breaking unions and suppressing local wages to make it easier and more profitable for multinational corporations to set up extractive operations. Currency devaluation. So the IMF frequently forces the borrowing country to devalue its own currency against the dollar. But while economists argue this theoretically makes the country's exports cheaper and more attractive on the global market, the immediate devastating reality is that what it really does is catastrophically increases the cost of all the imported goods. So in countries reliant on imported medicine, fuel and food, for example, this leads to immediate severe inflation for basic human necessities. So these policies operate as highly effective modern mechanism of neo-colonial wealth extraction. So the loans themselves function via a phenomenon known as the Cantillon effect. You can Google that. The World Bank and IMF provide massive injections of capital that overwhelmingly end up paying Western consulting firms, foreign construction conglomerates and international bondholders who held the original distressed debt. The developing nation receives the permanent crushing burden of the debt, while the actual economic benefits and capital are quickly funneled back to the rich, industrialised nations of the global north. The destruction of Jamaica's economy is a really good study in toxicity. So the toxicity of these loans is not merely a theoretical critique. It's visibly etched into the devastated economies and fractured societies of the global south. A glaring, deeply tragic example is the historic intervention of the IMF in the Caribbean nation of Jamaica. Following its independence from Britain in '62, Jamaica enjoyed a period of pretty strong economic growth and optimism, quickly achieving middle income status. However, battered by the global oil shocks of the 1970s and suffering from a massive financial crisis and spiralling debt in the subsequent decades, Jamaica found itself on the verge of economic meltdown. Locked out of international capital markets, the Jamaican government was forced to seek IMF assistance and submit entirely to structural adjustment conditionality. So the human cost of this intervention is chronicled powerfully by the documentary Life and Debt. Give that a watch. I think you can even watch it on YouTube for free. Before the IMF intervention, Jamaica possessed a robust, self-sustaining agricultural sector. They used to export like 20% of their food and had a great GDP. It was an agricultural nation, much less weed and coke and a lot less crime. Most notably, a thriving domestic dairy industry that provided local jobs and food security. However, as part of the strict loan conditionalities, the IMF demanded that Jamaica liberalise its trade policies and completely remove the protective tariffs that shielded local farmers from global market volatility. So as soon as the tariffs were forcibly lifted, the Jamaican market was immediately flooded with cheap milk powder imported from the United States and Europe. Its foreign milk powder was artificially cheap because American and European dairy farmers received massive agricultural subsidies from their own wealthy governments. Jamaican dairy farmers, who received absolutely no such subsidies from their bankrupt IMF-constrained government, simply could not compete with these artificially depressed prices. It wasn't just dairy powder, wasn't the only white powder involved, unfortunately, but the results were instantaneous and catastrophic. The domestic dairy industry, there we go, was systematically decimated. Jamaican farmers, unable to sell their fresh milk, were forced to slaughter their dairy herds and abandon their generational land. Shit times. Consequently, Jamaica went from being a proud, self-sufficient producer of milk to becoming entirely dependent on imported foreign food powder. By destroying domestic production, what the IMF policies actually forced the nation to do was borrow even more US dollars just so they could feed themselves. The broader macroeconomic results of this mandated austerity in Jamaica were equally grim. Real wages plummeted by 17% in just a few short years. Per capita GDP stagnated to levels lower than they were 2 decades prior, and the country found itself in an inescapable debt trap. Jamaica ended up spending significantly more money just servicing the interest on its massive debt than it spent on domestic capital expenditures like healthcare or education combined. The IMF policies essentially transformed a sovereign, independent nation into an exploited export processing zone and a perpetual debtor, illustrating exactly why these structural adjustment loans are viewed as deeply toxic to human development. Just have a bit of vape there. Keep you going. Global repercussions. So you've got Bangladesh and sub-Saharan Africa. So this pattern of destruction isn't isolated to the Caribbean. It's replicated all over the fucking place. In Bangladesh, World Bank and IMF financing actively pressured the nation to pivot away from self-sustaining traditional agriculture and toward the massive expansion of industrial shrimp farming, dubbed white gold, purely to generate export revenue and pay down foreign debt. To create these lucrative shrimp ponds, vast swathes of protective, ecologically vital mangrove forests were systematically cut away, and fertile agricultural fields were intentionally flooded with salt water, rendering the land a barren, watery desert. The local populations, including child labourers, were forced into grueling work collecting shrimp for less than $1 a day, while the massive profits flowed upwards to the ruling elite and outward to international creditors. Despite these extreme structural adjustments, Bangladesh's national debt didn't go down. It exploded from $145 million in 72 to nearly $96 billion by 2022, which is a lot, isn't it, really? In sub-Saharan Africa, the legacy of IMF structural adjustment has been paid in human lives for decades. The IMF mandated severe cuts to public health spending as a core condition of its loans. By the 1980s, health expenditures in IMF programmed countries had declined by a staggering 50%. Many experts have directly linked these harsh austerity measures to the chronic weakness of African health systems, citing this lack of infrastructure as a fundamental cause for the failures in disease surveillance that allowed the catastrophic Ebola outbreak in West Africa between 2014 and 2016 to spiral totally out of control. They just didn't have the healthcare infrastructure to deal with it. Even when the COVID-19 pandemic struck in 2020, the IMF's core philosophy didn't really change. Dozens of African nations were left tied up in rigid loan repayments that demanded continued austerity, leaving them with no united liquid money to spend on emergency medical preparation or vaccine procurement. In a lot of instances, the emergency funds provided during the pandemic were simply recycled straight back to the IMF to pay off old debts, doing nothing to help the dying populations. Exploring solutions. So what the fuck can we do about this? The mechanics of sovereign money and monetary reform. So faced with the profound mathematical instability of fractional reserve banking, the unmanageable, terrifying 250 trillion quid global debt matrix, there is no spoon, overseen by the BIS, and the predatory neo-colonial nature of international debt dependency enforced by the IMF, macroeconomic theorists and global report reform campaigns have proposed a fundamental root and branch restructuring of the financial systems. And the most prominent, comprehensive and heavily researched solution is the implementation of a sovereign money system. This concept is not entirely new. It has deep historical roots, originally proposed by economists like Irving Fisher and Henry Simons in the aftermath of the Great Depression as what they called the Chicago Plan. It's frequently referred to in academic literature as basically 100% reserve banking, or just full reserve banking. So when you put your money in the bank, they can't fucking lend out the money in your current account and then become insolvent and give you nothing back. Well, except for like 65 grand if you live in the UK. There's something called the Financial Services Compensation Scheme. You look on the back of your bank statement, it says it in small print. Even if you've got like 200 million quid in the bank, all you're getting 65 grand or 67 grand. It's quite shit, really. In a sovereign monetary system, the extraordinary power to create money is completely and legally stripped from private commercial banks. Banks are absolutely prohibited from creating new digital deposits out of thin air when they issue loans. Instead, the exclusive authority to create all money in the economy, both physical cash and digital currency, is returned to the state, operating through a transparent, highly accountable public body, typically an independent monetary creation committee situated within a central bank. Under the new architecture, if a commercial bank wishes to lend money to a customer, it must actually act as the true financial intermediary that the bank currently mistakenly assumes it to be. So the bank must first borrow pre-existing sovereign money from actual savers and investors. this is under the Chicago plan, before it can lend those specific funds out to a borrower. Sounds like basic rules, but not one they stick to. So the central bank, meanwhile, would inject new debt-free money directly into the real economy. It would do this not by lending it to banks, but by financing government expenditure like building green infrastructure, funding healthcare, or paying teachers, or by distributing a direct citizens' dividend. Like any paradigm-shifting macroeconomic policy, the transition from a 250 trillion debt-based global economy to a sovereign money system carries distinct transformative advantages, as well as theoretical risks and trade-offs. I'm not going to read that massive chart, it's boring. While critics raise highly valid concerns regarding the friction of transition and the historical dangers of political mismanagement of the printing press, advocates of monetary reform maintain that these risks are vastly outweighed by the catastrophic observable realities of the current system. They argue that a transparent, democratically accountable committee governed by strict inflation targets is inherently superior to an accountable cartel of profit-seeking private banks whose reckless credit creation guarantees recurring devastating financial collapses, the prerequisite for global progress, climate change, human rights, and social justice. So the discourse surrounding monetary reform is frequently and tragically relegated to the dusty corners of academia and specialised financial think tanks. However, the architecture of the monetary money system is not a niche issue. It's the invisible binding thread that connects every major progressive struggle of the modern era. So whether an activist, a journalist, or a policymaker is dedicating their life to fighting catastrophic climate change, defending fundamental human rights, eradicating global poverty, or advocating social justice, it must be recognised that every single one of these causes is far more likely to succeed with a functional domestic economy free of national debt-based currency. So the climate debt trap, the intersection of debt and climate change, is actually particularly acute and deadly. The current financial paradigm operates on a strict structural requirement for infinite compound growth. The economy must continuously expand to service the continuously expanding matrix of debt. This mathematically limitless demand for economic expansion crashes directly into the finite ecological limits of the planet. It's physically impossible to achieve global sustainability in an economic system where failing to consume more resources year over year results in devastating financial depression. Furthermore, the nations most vulnerable to the severe impacts of climate change, primarily situated in the global south, are trapped in a vicious, inescapable climate debt trap as extreme weather events, rising sea levels, and severe droughts destroy local infrastructure and decimate agricultural yields. These nations are forced to borrow heavily from the IMF and private creditors simply to recover and rebuild their societies. Because this debt is denominated in foreign fiat currencies, overwhelmingly it will be US dollars, these nations must aggressively exploit their natural environments to generate an export revenue required to service the interest. This brutal dynamic forces developing countries to engage in rapid deforestation, aggressive fossil fuel extraction, and highly unsustainable mining practices just to avoid sovereign default. They're entirely stripped of the fiscal space necessary to invest in green energy transitions, climate adaptation, or resilient infrastructure. Without massive debt cancellation and the implementation of a debt-free monetary framework, the global south physically cannot afford to participate in the fight against climate change, and environmental justice is fundamentally impossible without debt justice going hand in hand. Human rights and the eradication of poverty. So similarly, the realisation of fundamental human rights is intrinsically, inextricably linked to monetary sovereignty. International human rights frameworks boldly guarantee the right to health, education, decent living conditions, and freedom from extreme poverty. Yet these rights are not free. They require massive, sustained, and stable public funding. In a fiat system where nations are beholden to external creditors and rigidly constrained by the austerity and structured adjustment policies of the IMF, state revenues are forcefully diverted away from public welfare and directed outward towards debt servicing, paying their money back. So when a developing country has to spend over half its national budget simply paying interest to foreign bondholders. Hospitals don't get built, schools fall into disrepair, clean water infrastructure crumbles. The mathematical reality of 250 trillion quid in a global debt matrix means that poverty is not a tragic accident of history. It's literally an engineered structural feature of a system that continuously siphons wealth from the poorest citizens to the wealthiest financial institutions. A sovereign, debt-free monetary system provides the exact mechanism required to break this devastating cycle. By allowing a state to fund its own domestic development without incurring compounding interest to private profit-seeking entities, governments can reclaim their macroeconomic policy space. A functional domestic economy insulated from the predatory fluctuations of global fiat currency markets and the diktats of international creditors is the absolute bedrock upon which all social justice initiatives must be built. Eradicating systemic poverty and securing human rights are unattainable utopian goals as long as the very currency used to facilitate human cooperation is specifically designed to indebt the public. A call to awareness, the revelations of 97% owned. To break the hegemony of the current financial architecture, widespread public and journalistic comprehension of the money system is urgently required. The general public can't fight an enemy it can't see, and it can't dismantle a system it does not understand. To this end, it is absolutely imperative that journalists, policymakers, activists, and just ordinary people like me and you engage with the well, you don't just have to watch this documentary, but if you do, you'll find it's very good. 97% owned, directed by Michael Oswald, represents a watershed moment in the public communication of complex macroeconomic realities. The documentary systematically dismantles the pervasive myths surrounding money creation, boldly tackling the profound questions that orthodox economics has largely ignored or deliberately obfuscated. Where does money actually come from? Who truly has the power to create it, and who decides how it gets used? And what are the devastating social consequences when that awesome power is centralised in the hands of private commercial banks? Featuring rigorous, verifiable research and extensive, frank interviews with prominent economists, former bankers, and leading monetary reform campaigners like organisations like Positive Money, the New Economics Foundation, and the Jubilee Debt Campaign, the film exposes the hidden inner workings of the UK's debt-based financial system. It reveals the astonishing mathematically proven reality from which it derives its title, that 97% of the broad money supply exists only as credit typed into existence by private banks when they issue loans. 97% owned is essential viewing because it masterfully bridges the gap between opaque, highly technical central banking policies and the very tangible daily suffering of ordinary people. It clearly and undeniably demonstrates how the privatisation of money creation inevitably leads to the rampant inflation of housing prices, the consolidation of extreme wealth at the top, and the devastating boom and bust crises that routinely wipe out the hard-earned savings of the working class. For any investigative journalist seeking to uncover the true root causes of systemic inequality, or any citizen wishing to understand why global debt continues to spiral out of control, endless political promises, watching 97% owned is not merely recommended, it's a fundamental intellectual obligation. Pretty strong terms there, but yeah, it is really good film. You can watch it on YouTube. It's like it's on YouTube under other names. If you see one with a really sort of pronounced female orator narrating it at the beginning, you probably found it. It's really nicely shot and edited and polished, and fact heavy and revolutionary. Once you've seen it, you kind of can't unsee it, and it all sort of makes sense. It says here, a fundamental intellectual obligation. I would just say, a stark recommendation if you want to know a bit more. Once the mechanics of money creation are fully understood, the illusion of the current economic paradigm shatters, making the necessity of radical reform undeniably clear. As the documentary highlights, once you understand how money is created, you can no longer be controlled by the narratives of the financial elite. Conclusion: the ultimate pragmatic imperative, the architecture of global finance, more architecture there, is not a force of nature, nor is it an inevitable law of physics. It's a human construct built upon deliberate legal and political choices. Since the transition away from the commodity-backed Bretton Woods Agreement in the 70s, the global economy has been subjected to an unprecedented, highly volatile experiment in fiat debt-based money creation. Overseen by the Bank of International Settlements, this system has allowed a cartel of private commercial banks to generate an unmanageable, mathematically unsustainable matrix of over £250 trillion in digital debt. It's a lot of money, isn't it? The consequences of this system are uniformly disastrous for the vast majority of the global population. In the advanced economies, fractional reserve banking funnels wealth upwards into speculative asset bubbles, hollowing out the productive real economy and guaranteeing periodic catastrophic financial collapses. In the global south, the toxicity of the system is amplified exponentially through the predatory conditionalities of IMF structural adjustment loans. So these loans force vulnerable nations to cannibalise their own public services, exploit their fragile environments and destroy their domestic industries simply to generate foreign currency required to service unpayable compounding debts. So analysing this system reveals a profound, inescapable truth, which is that the diverse, seemingly disparate crises facing humanity today aren't isolated incidents. They're overlapping, interlocking symptoms of a shared structural disease. It's mathematically impossible to achieve a sustainable ecological balance, guarantee universal human rights, or eradicate global poverty within a monetary system that requires infinite compound growth and systematically transfers wealth from the poor to the financial elite. Therefore, transitioning away from private debt-based currency creation towards a democratic sovereign money framework is not like an esoteric economic debate reserved for academics. It's like the ultimate prerequisite for planetary survival and social equity. While the implementation of a sovereign money system does carry transitional risks, the alternative is the continuation of a paradigm that mathematically guarantees ecological ruin and perpetual economic servitude. Monetary reform is by far the most pressing, urgent and pragmatic social political issue affecting almost every country on earth. Until the power to create and distribute money is reclaimed from private banks and restored to transparent democratic institutions acting in the public interests, all other political and social endeavours will remain profoundly constrained. The blueprint for a just, equitable and sustainable future already exists. It requires only the collective public awareness and the political courage to rewrite the fundamental code of the global economy. Thank you very much for watching me dribble about that. If you just put in 97% owned into YouTube, right, there's like about 4 or 5 rip-off versions that are like not copyrighted, and you can just, it's the same documentary, it's just called something else. Check out Positive Money's website. I used to donate money to them and attended loads of their events as just sort of like a dog's body to like stack chairs and tables and get a bit pissed with a bunch of economists at a wine and dine buffet afterwards so they can post lecture kind of mingle and talk to people and get to know everybody and, you know, promote their literature and campaign architecture and shit like that. It's really important, monetary reform. It's like the most important thing. If you don't know about it, just get to know about it. And once you do, I don't know what the fuck you're going to do to stop it, but like knowing about it and understanding it's the first thing. Banks create money when they make loans, not the Bank of England, who prints money in coins, but digital money costs fuck all. They type it into a computer and then we have to spend our whole fucking lives working to pay it back when they did nothing but type a load of zeros into a keyboard. With that caveat, I wish you a good afternoon and thanks for your 59 minutes and 13 seconds for watching.